right, let's get stuck into part two, the continuation from last week's podcast. Last week talking a lot more about Phil Anderson's 18.6-year real estate cycle, where we are at right now in 2022, what's going to happen leading up to the top. Now, if you haven't already listened to that one, I highly recommend going to listen to episode 60. But then this is a continuation from that, where we go into some more Australia-specific information. So we go through an article recently produced from Simon Pressley, where he talks about could house prices double in some parts of Australia, even with the coming interest rate rises. And we go through a lot of different information that he talked there, which got us really excited.
You know, it's crazy because, you know, the media is absolutely bashing many parts of the Australian economy, the government, businesses, the stock market and property at the moment. And there's a lot of fear around. And I think these types of solid articles where we talk deeply about this just help give a different perspective based on 50 years instead of 15 minutes worth of information. And I really, really like it. I'm so grateful to Simon that he spends the time putting this stuff together. Highly recommend you check out his stuff over there at Propertyology in terms of his blog and his news and insights. But this podcast is filled with absolute gold. When I read this, I have been sleeping better.
Oh yeah, there's no doubt about it. I'm feeling a lot more confident and you know, it's backed by a lot of history. It's backed by previous growth cycles. And that's all we can do, forecast in the future. All we can do is look back at the past, and definitely made me sleep a little bit better and got me excited. I actually want to buy another property now.
I'm not buying another property. Bought one each. No, I'm excited as well because, you know, the confidence that we got from part one with Phil and the confidence we've got with Simon from the RBA, from Commonwealth Bank at the moment, from Core Logic, it's going to be a great opportunity to buy if you can stomach a little bit of a dip in Sydney and Melbourne in the next 6 to 18 months. It's an incredible opportunity if you're trying to buy the bottom or just off the bottom of your Brisbanes, your Perths, your Darwins, your Adelaides. There's great value still in Australia if you know where to look, and there's a lot in this article and this podcast to answer some of that fear that's popping up in the media right now that may be real, or maybe it might just be keeping us scared.
Sweet as, let's get into it. Now, one of our favourite commentators in the property space, especially here in Australia, is Simon Pressley from Propertyology. He's been writing blogs, articles for ages now. He's been investing for a very long time. I think you mentioned you've been following him for over 9 years or something now as well. You know, today what we're going to do is kind of break down one of his more recent articles where he talks about house prices could still double even with interest rate rises. Now, he provides a lot of logic, data, history, graphs in this article, which we're going to break down throughout today, which I'm really, really excited about. But go over to his website, check out those blogs, subscribe to them, because, you know, every couple, like twice a month probably, is producing some absolute gold. And this one was one of the more relevant ones for us, obviously talking more specifically about the Australian market, talking about what the next 6 years could look like, putting out his picks and tips and predictions over the next little bit as well. So let's dive straight into it.
For sure. So this is carrying on from where we're at, which is part one, the Phil Anderson piece. You know, Phil's big picture, where Simon's, you know, also big picture, but way more of an Australian context. So, you know, this is going to be a little bit like the last one, like lots of information and our thoughts on it. But the first line of this article is gold. It's like, believe it or not, even with rising interest rates and inflation on the horizon, the median house price in many Australian locations could double in value over the next 6 years.
Boom.
That's the sort of like thing that makes you sleep a little bit better, right? Whether or not it happens, he doesn't know, we don't know, Phil doesn't know, but history has shown us that many locations could go through that sort of growth, which is just insane to think right now. But then I read an article from Commonwealth Bank a couple of weeks ago, and Commonwealth Bank saying they believe inflation on wages is going to be so high because wages have been so suppressed for 15 years that all Australian locations and cities by the end of 2023 will feel affordable again.
There you go.
Even Sydney and Melbourne, based on how much of a wage increase they reckon's coming.
That's massive, isn't it?
Absolutely massive, man. So continuing on from there, we'll go through some of like the logic, because that's a hell of a statement to make without
It
backing
is.
it up.
And, he does back it up in this article, and that's what we're going to bring to you today. But, like, he's not just plucking these numbers out of thin air. He's gone back and looked at previous growth cycles. He's probably looked at a number of years of data to pull these things out. And it's not just based off, plucking a number out of the air and just putting it out there for everybody to predict, but it's actually based on logic, history, previous growth cycles.
For sure. So he goes on to say that history is proof that this time 20 years ago, last real estate cycle, when Australia had a national property boom, variable home loan interest rates increased 22 times in 6 years, and the house price in most locations more than doubled. He went on to say that Brisbane grew by 127% during that 6 years with 22 interest rate rises. 2 other capital cities did even better.
It's really, really nice to hear that, because it's not what people will make you believe at the moment. I think what we're seeing is a convergence of a number of different things. Now, one thing that Phil talked about was, interest rates aren't rising right now, they're normalising right now. So we knew that the RBA was going to pull them back up to pre-COVID norms. So they're just coming back to where they're normalising. And what Simon says, they've actually got to come up 5 times before they get to where they were back in 2019. So one of the cool things in the article was talking more about household finance in Australia, which has been a common narrative for the major media outlets and a lot of different experts and economists out there at the moment. So what did this go into say? Because it really changed the tune as to what has been commonly talked about.
One thing that I will say is that our grandpa, who bought for $8,000 DY on the Northern Beaches, thought that was too expensive.
Yeah.
I got his diary and a property book that he was reading when he passed away. And in his diary, it said, I've worked out that it'll take me 32 years of my wage to own this $8,000 property outright.
There you go.
So it's always expensive. There's nothing new under the sun. It's never the right time because there's always fear, right?
Exactly.
But this is what I love, because this is so counter to the media. We always hear in the media the first thing is that incomes to debt ratios are so high, it takes 12 times the average income in Sydney to pay in the own average home outright, where when our grandparents were alive, it was 4. Well, Simon actually does the maths on this properly using proper ABS data, core logic data. Housing interest expense to income ratio is only 4.4 times the average income.
Okay.
So it is so much lower for the average person across Australia.
Yeah.
Yes, if you've just bought a $2 million home in Sydney on a 200 grand income with a 10% deposit, then it's going to take you 10 to 15 years to pay off the principal component, let alone the interest.
Yeah.
But it's so irrelevant for the rest of Australia. There's currently $1.3 billion worth of extra savings in offset and redraw, which you've talked about in previous vids on our YouTube channel. And at the moment, the average place in Australia has a 30% LVR. The average home has a 30% LVR.
Wait, can you just explain that just a little bit differently, a little bit better there?
Yeah, so from reading this, the average home in Australia, the average person with debt on their own home or an investment, LVR is at 30%. So the average person has around about 70% equity. Now, we've got to remember that 30 to 35% of Australians own their home outright.
Yeah.
30% of people are renting.
Yeah.
So there's 35% of them, like myself, that are still paying off their investments or their home. And because a lot of these people haven't done anything for 10 years, the values have gone up, the debts have gone down, or there's a lot of people that bought 20 years ago.
Yeah.
It's just insane. It's like that have you think that every person in Australia is completely over leveraged.
Yeah.
It's the opposite of that.
Yeah, that's so fascinating, isn't it? And that's obviously why the RBA feels comfortable rising the interest rates, because they're looking at the economy going, most Australian households are in a very positive position right now. So if we look at, the 2022 Australian housing market outlook, what's Simon sort of predicting moving forward?
That's a really good question, man. Like there's 2 things that he calls. One is positive things, lift things, and then there's negative things or drag things. So the negative things is inflation. Affordability. Like for the first time, I tried to buy in Sydney, Melbourne, Sunny Coast, Gold Coast, Geelong. It's ridiculous, and I really feel for them, which is why so many people are moving. There's the federal election, third election that we've seen since we've been in business. Every time people get super scared till 3 months after it, realise nothing changed, and then they get back on the horse. tighter credit assessment, like APRA is screwing things in a little bit further. There's a labour shortage. There's just, he calls it lemon sucker commentary. There's so many people giving property a bad rap right now, which is so normal after a 30% year last year.
With no context as well, but this is the context that we're getting. You know, there's a lot of positive things that are happening, which is sort of why Simon believes things could potentially go up. You know, just going through some of the lift, I guess, indicators, we've got overseas migration. So we've had limited to no population growth over the last couple of years because the borders were closed, but now things are starting to ramp back up. We've got lifestyle buyers, so people wanting that sea change or tree change because of the ability to work from home, so it's putting growth in different areas. We're seeing wage growth in a number of different sectors, and this is expected to continue and start becoming a reality in a lot of different sectors as well. You've got people upgrading their PPRs, so they've experienced a decent amount of growth. They're ready to take it to the next level. You've got high home equity, you've got rising rental incomes at the moment as well, which makes it easier to make those repayments on your mortgages. International tourism picking back up. You've got $230 billion worth of household savings, which is just ridiculous.
Is that right? Because, in the last slide he says
1.3.
And then I knew that I'd seen that somewhere. So what's the exact language that he says there?
$2.3 billion in household savings, which is crazy. We've got dirt cheap home loans right now. Like, people are still getting interest rates below 3%.
I just got one literally approved 2 days ago, and it's at 2.39%.
As an investor?
I know that you've got fixed rates below 2%, don't you?
Yeah, I've still got 3 home loans below 2%.
It's absolutely insane.
It's nuts. There's $45 billion worth of infrastructure spending in Australia at the moment. There's record low resale supply. Construction material and supply constraints as well, which is putting some of the pressure on those property prices as well. So a lot of positive things. And, when some people talk about the negatives, like, there's a reality. There is some negative things happening around the world which could impact the market, and we don't know what's going to happen, but I'm sick of people not talking about the good things that are happening out there as well.
I love this, bro, because what you just said leads perfectly onto it. Literally his next line is, "It is nothing more than baseless BS to think big critical mass of mortgage holders will suddenly struggle when interest rates decline." Now, one of my best mates in Sydney runs a very successful business down there, owns 4 great properties. Literally texted me yesterday and he's like, "Do you think there'll be any opportunity to pick up places that are distressed sales when interest rates rise?" And I'm like, I just literally sent him this article back and I'm like, we'll talk about it after you read this.
Yeah.
Because that is the narrative. It's like, there's going to be massive foreclosures and struggling. I'm like, if the average person has saved a little bit of money, like, there's going to be people that are leveraged at 95%, that
100%.
that lose a job, that are a single income family, that are going to be pressured, but they would be pressured now.
It's not the average.
They're pressured now. It just isn't at a critical point right now.
Not yet.
But I think the foreclosures in Australia are at the lowest level they've been in a long, long, long time right now.
And people missing their repayments on their mortgages is at extreme low levels right now as well. So people are making their repayments. What's the next thing that this goes into? What's the next little pocket of gold in this particular propertyology one?
This is the thing. Like, I'm just trying to read into this. He talks about 50 years of evidence, which I love. Now, this is available in his news and insights part of his website. Like, it's extremely good stuff. So he said, interest rate rises were extremely common through the 1970s and 80s. Like, I've heard mum and dad talk about how hard it was to get into the market. What happens when interest rates normally rise to a crazy level is, because the banks are making so much money from them, the cash, like, people are also, they don't talk about this, that if you had cash at that time, put a deposit into the bank and get 17% that year.
Yeah.
Or, that everything else was going up at the same time. Like, it was just chronic overinflation, really.
Yeah.
So he goes on to say that during that 6-year period, which I think was 2002
through 2008,
the median house price more than doubled in 100 individual cities and towns, including 6 of the capital cities.
That's massive.
He goes on to give some examples, like property boom occurred as far north as Cairns, 147% during that time. Burnie in Tasmania and Albany in the West did 199% during that 6-year period.
Whoa, that's massive.
6 consecutive years of interest rate rises between 2002 and 2002 and 2008 did not stop spectacular capital growth in locations. In Port Lincoln in South Oz did 109% during that time. Goulburn did 103%. Launton in Tassie did 166%.
Wow. And what were the underperforming markets around Australia at that point in time?
That's the right question. It's like you're just pre-scripting what's coming here.
I've read this article once or twice.
Yeah. Sydney during that time, because it had already gone through a hectic boom in the first half of the cycle, only did 26%. Melbourne did only 66%. It was really Melbourne and Sydney, honestly, like we've looked at previously, because they went through such big growth. They'd already priced that 6 years into their previous cycle.
And what we talked about in part 1 of this podcast, talking about the Phil Anderson, was the averages over the 14 years worth of up in the Australian markets. And, that gives us a little bit more context. Now, it's really interesting to see all of this because we also overlaid 46 years worth of property price growth from an article done by Homely, along with the Phil Anderson real estate cycle. And like we've said, generally at the beginning of a cycle, your Sydneys and Melbournes in Australia are the top performing markets, and also the regional markets surrounding those big cities. So, your Newcastles, Wollongongs, Geelongs, Mornington Peninsulas, these areas do extremely well. Then after the mid-cycle slowdown and into the second half of the real estate cycle, which previously was 2002 to 2008, now that's more like 2022 through to potentially we'll have to wait and see how that all unfolds. We see these other markets around Australia hit their stride and start generating some really positive capital growth. So, we've been talking about it for years now that we don't see as much value in Sydney and Melbourne right now because they've already been through a huge growth cycle. Now, they may continue to perform well in this second half of the cycle, but history tells us that markets like Brisbane, like Perth, like Adelaide, like Canberra, like Darwin, and some of these other small regional towns should be the top performers.
Based on the history, bro, Perth did 147% last time. Hobart did 139. Darwin and Brizzy both did 127. Canberra did 103. Incredible results. And, you can start to see where he's drawing correlation. Now, things don't always happen the same way, which we talked about in part 1. But what I love is he goes on to this concept of beware of your source of information. Now, I'm a huge believer in, I like Phil, I like Ray Dalio, I like Warren Buffett, I like CoreLogic, I like Simon Pressley,
CBA.
I like Homely, Heron Todd White, CBA, all of the banks. I like investors that are financially free that are over the age of 50 because they've seen 2 or 3 cycles, whether they knew about them or not. Outside of that, I very much limit my association. Now, here's some of the headlines between May 2019 till now. What we've got to remember is there is always a reason to be scared. There's always a reason to be fearful. And many people that I'm speaking at the moment are coming into the market because of this fear and because it's a better time, that have been sitting on the fence since 2018, 19 and 20, looking back and going, shit, I've missed 30% in some markets in Australia, and others I've got a great opportunity still. In 2019, the media was batting on about end of negative gearing and everyone freaked out. That was the last election. People freaked out. Then we had the bushfires. We had the imminent recession in March 2020 coming. International borders closing in February 2020. We had the rent stuff come up where people could just bail properties and they were doing that. We had the end of JobKeeper in 2020.
Excuse me.
The end of the home loan deferrals. So people thought as soon as they stopped this, like giving us 3 months of just pausing our home loans, we'd get this mass exodus of properties being sold. As soon as JobKeeper was ending, apparently property prices and the economy was supposed to fall off a cliff. Interest rate rises is the talk at the moment. The Russian and the Ukraine conflict, the inflation and the cost of living rising, the floods. There is just always something in this media cycle to be either super excited about or on the flip side, and most of the time, just shit scared about.
It's crazy. And like, to put this into context, we worked with a client back in 2017 where we helped her purchase a property in a great up and coming suburb of Brisbane. Now, back in 2017, we bought that property for $700,000. Now, she recently sold that in early 2022 for $1.4 million. So whilst all of this narrative, this negative sentiment around the media, you also, which isn't in there, you had at the beginning of 2020 people calling a 30% drop in property prices.
CBA said that.
Yep. So like, you've always got somebody predicting these, I guess, collapses coming or something like that. But you've got to really be able to analyze the markets, identify where the value is, and safely enter into those markets at the right time, which can be really challenging, but with the right support can become a little bit easier. But, I think this is going to be a common occurrence moving forward over the next 12 to at least 18 months. There will still be some negative sentiment and negative narrative around the property market. And like what Warren Buffett says, like, this can be a really, really, really opportunistic time to capitalize on that while you aren't competing with too many people, because based on where we're at, based on what could potentially happen over the next 6 years, is pretty outrageous.
What I love, man, is everything you just said, and it refers back to this conversation of debt. Like, one of the biggest reasons people are spooking is because we haven't seen an interest rate rise in 10 years and people don't know their history. The second thing is this concept around debt. Now, like, he goes on to say, from the ABS, of the 10.7 million properties in Australia, 1 million of them have sold in the last 2 years. It is therefore reasonable to assume that 90% of Australian households have not changed, therefore taken on any extra debt in the last 2 years. In fact, a large proportion of households have 20 to 45% more equity in their home than they did 2 years ago, so they're better off. More importantly, there are massive amounts of slack in household budgets to absorb several rate rises, and the RBA knows that. He goes on to say, for many years, most homeowners have been paying above and beyond their average mortgage repayments, and the RBA has confirmed that there is over $1.3 billion in cash reserves, as we talked about, and redraw. But more importantly, 35% of Australia's loans are more than 2 years ahead of their repayments, meaning they could talk to the bank and pause for a while and still be completely in line with their banking terms. So he goes on to say, mortgage stress, give me a spell.
Yeah, seriously.
Love it.
Yeah, I love that too. And it's just good to debunk what's going on, because, regardless of what's going on, the media needs to run a business. They're running a business. They've got to keep jobs. They've got to employ people. They've got to continue bringing in revenue. And, the unfortunate reality is fear sells more headlines than positive news. And, people like to attach onto this stuff. And the last 2 years has been an absolute prime example as to how people like to do things, how the media like to do things. So it's so imperative in these stages of the real estate cycle to go to that deeper level of understanding and knowledge around property investing, or just investing in any asset class.
What I've learned from going super deep into like different asset classes using Ray Dalio's data is that property is one of the only asset classes that inflation doesn't eat away at. It might eat away at the real return in that year. If prices went up 10%, inflation was 6%, there's a 4% real return.
Yep.
But at some point, the benefit of inflation, because the value's going up, your rent's going up, and the debt stays the same, but the debt is worth less because wages have increased as well, becomes absolutely amazing. So he said, on the flip side of rising inflation and interest rates, we're at full employment nationally. We're going to be at 4% by the end of 2023. Government and business revenues are rising. When the stock market, and Phil talked about this a lot at the event, when the stock market is increasing in value, it's normally because profitability in business is increasing, and that's a sign of the strength of the economy. The only reason they're increasing interest rates at the moment is to hedge against inflation and to slow the price growth down.
Because we can't have multiple 20% growth years in a row. And when we looked into the Homely data, it was extremely rare for these capital cities around Australia to experience 20% plus growth years. So, we can't see that. Like, everyone always talks about how hard it is for first home buyers to get into the market and things like that. And it's like, if things continued the way that they were last year, it would be impossible for anybody to ever get into the market. So there's always got to be a natural slowing effect. And fortunately, we've got a great Reserve Bank and government that do these things so that they do manage it.
100%. Now, I love that, bro, because he said that housing supply has never been tighter, and he hasn't seen in the last 20 years a more positive looking economic environment for growth over the next 5 years. So he said there's 200,000 dwellings at the time of writing this article for sale in Australia. If you take out Sydney and Melbourne, there is such a fraction of dwellings for sale Australia-wide. He said the previous record low was 12 years ago. So this is the lowest number of listings that we've seen. The population was 4 million less people. So there's 4 million extra people competing for like an historical low number of properties for sale right now. It's crazy. That's sort of where he finishes it. I will say one other thing from another article of his is he is expecting rents to increase with inflation by $200 per week by the end of 2023 in Australia. CoreLogic's also suggesting about $100 a week increase in those rents as well this year alone. The reason we brought you part 1 and part 2 of this series is to just help you understand that if you follow Phil's stuff or Simon's stuff, there is alternative opinions out there based on data. He doesn't have an opinion. He's just bringing data. Phil is looking at 200 years of data, and they're just going, here it is. Take it or leave it based on previous cycles. This is what happened. We don't know what's going to happen, but some of the fundamentals look good, and the media aren't talking about them because the media is hooked on fear, and they've got us all shit scared right now. Yeah,
the reality is nobody can predict the future. Nobody knows what's going to happen. So the best thing for us to do is to look back in history, because if we can't predict the future, we still need to make an educated decision. And to go back in history, it can leave some clues as to what could come next. And like something that we talked about off camera is just like financial freedom isn't going to happen organically. Like you need to work away at it. You need to overcome those challenges and overcome the fears that we all have. Like I get scared all the time. Like I'd always get fearful of the market, but then rather than going into inaction, I go into research and study, and I try and learn a little bit more to find that confidence to execute my goals, because I know I want to have choices in the future. I know I want to have a great life. I know I want to have a passive income. That's not going to create itself. I've got to still take action. I've still got to do something, and doing something from an educated background helps me feel a little bit more confident, helps me take that necessary action and move towards where I want to be in the future. Because, I've seen so many people, unfortunately, sit on the sidelines for a couple of years and miss out on those really positive times that we've seen over the last 4 years. And, I don't want to end up in that situation in the future. I want to be on the right side of the equation, if that makes sense.
I love that, man. Like I've got very, very, very good friends that are just starting to invest now. And I've spoken to thousands of clients, as you have, or thousands of people. And some of these people have been waiting since 2005 to buy. Some of them have been waiting since 2010 to buy. Others have been waiting since 15. And it's like, there is always a very real reason, depending on your life stage, to not do something. And as we've shown in part 1, there are stages of the cycle that are dangerous if you're a short-term investor that's over-leveraged, and you can get very burnt. But if you're a long-term fundamental investor that goes for quality markets, quality locations, quality suburbs, quality streets, quality, properties and land sizes, and follows fundamentals around DSR scores, around vacancy rates, around 10-year averages, property is just so simple. And that's what we hope to bring you guys through our stuff. It is just look at a whole bunch of different ideas, decide what type of investor you are, make a really, really, really simple plan. And you can look at our 3 properties to financial freedom strategy, or our 2 properties, 2 granny flats to financial freedom strategy is a great starting point. They're both available on our YouTube channel or the podcast, to just go, I completely understand that there's always going to be a whole bunch of stuff here, and my emotional fear survival body is always going to protect me from risk. And it can't differentiate the risk between a bear in the room and more debt in your bank account. It feels the same. And unfortunately, that's the reason why 90% of Australians end up on the pension or some sort of government assistance. As Phil spent 5 hours talking about, we don't manage it correctly.
That's so true.
Everything is a risk. How do we manage it to get the best result? The way that Simon and I are doing it is buy, hold at the right time in the right stage. But if all you did was buy and hold longer term, you'd be absolutely set up in 30 years. And if you want to be really set up in 15, you know, learn this stuff and apply it, or become one of the tiny or the small number of clients that we work with each week and learn from our experience from having done this. And it's not just what we've done personally or what we've done for clients, it's what we have heard from the 3,000 people that have bought Sydney, Melbourne, Perth, mining towns, America, Europe, Asia, and this didn't work, this worked, this didn't work, this didn't work. And it's like, I learn from every one of them. As soon as I hear a fundamental that made a difference that I haven't priced in or like put into our process, straight in, immediate change.
100%.
Get better and better and better. And when you constantly do that, it's like, holy sheesh, it is so simple.
Yeah, and the compound effect of it just makes it so much easier to execute as well.
For sure. Like, I love what you've done. I'm really proud of like my portfolio now. I'm proud of our team members, our clients, because the fundamentals that have worked are working, and the proof's in the pudding and the results, and it's amazing.
Bro. Yeah, no, so stoked and excited to see how it all unfolds. But thanks again for producing that information for us all, Simon. Keep doing it. And yeah, on to the next one.
Woo!
That's a wrap.
That's a wrap.
Have a spin. Yeah. Oh, sweaty. So sweaty. Oh, that's good. Look at that. So nice, eh? Oh.